is the CAPM dead? A lot has been written on the CAPM. The CAPM is the standard model in finance for analyzing risk and expected return. Indeed, since the mid-1980s, the capital asset pricing model has been under attack. The beta has been documented to be an incomplete measure of risk. However, the attack on the CAPM certainly escalated in the 1990s. And what I'd like to do is to explore, in a little way, some of the criticisms of the CAPM, and hopefully that'll lead us to producing a model that performs better than the standard implementation of the CAPM. What happened with a very famous and impactful paper published in 1992 called The Cross-Section of Expected Returns by Fama and French was evidence that if we looked and tried to explain the cross-section of expected returns, which means trying to explain why one stock experiences a higher return than another stock over time. If we look at that problem, traditionally, the CAPM would say that the only thing that explains the differences between returns on different securities, the expected returns, has to do with the beta, which is a complete measure of risk. The beta being the contribution of this particular security to the variance of a well-diversified portfolio. Well, what happened in the Fama and French paper was that they looked at two additional factors. And these factors were related to the price-to-book ratio, and the second factor related to the market capitalization. And what they documented was if we add these two factors related to price to book and capitalization, that the ability of the traditional beta to explain differences in expected returns across different securities went away. That the factors based upon price to book and market size tended to knock out the beta from the CAPM. Now, a lot has been written criticizing this paper, trying to explain why this might have occurred. And indeed, this paper is important for many different reasons, and perhaps one of the most important reasons for me is that it got people to really think about what's going on and to explore different asset pricing specifications. Well, there's one way that I actually like to look at this problem, and let me try to pitch this to you. That the usual implementation of this type of test assumes that the betas are constant through time. Now, I'm actually a believer in betas changing through time. So it seems to me that if we're going to give the CAPM a fair chance in a test against competing factors, that you should actually allow the beta to change through time. But that's not how the test was implemented. And indeed, if you really think about this, what are the things that might influence the beta changing through time? And one item that I think of immediately is the leverage of a firm. Look, we've all, unlevered betas. We know the relation between leverage and beta. But we also know that leverage is dynamic. The market value of debt divided by the market value of equity depends on what happens to interest rates. It depends on what happens to the value of the market for that particular security. So as the capital structure changes, the ratio changes because of market conditions or other conditions, the beta also changes for the firm. Now, if you try to think of certain information variables that might help us in modeling the dynamic nature of the beta, one that immediately occurs to me is the debt-to-equity ratio, but we also know that the price-to-book ratio is correlated with the debt-to-equity ratio. So there's a possibility that these other factors that we see coming into the regression that are so-called knocking out the beta are really factors that explain why the beta changes through time. So another interpretation of this evidence is that this doesn't say anything about the CAPM. Indeed, what it does say is that really what you need is a CAPM where the beta is dynamic, and it's likely that these factors that are coming in are just proxying for a changing beta. So another test that I've actually done some research on would be to allow for a dynamic beta, to allow these characteristics to influence the beta through time. Now, I really didn't answer the question, is the CAPM dead? And I think the correct way to look at this is to have the right perspective. The CAPM is a model that is an approximation of reality. We know it's incorrect. It's a very simple model. So really, given that we know it's incorrect, I guess you could say that it's dead. But practically speaking, we use incorrect models all the time. And the real question is there a model that is also incorrect that's less incorrect than the CAPM? And what we explore in this course are two classes of models that actually fulfill that. We'll look at multifactor models, where we specify a number of world risk factors. And we'll also explore a model that looks at not just variance risk, but skewness risk. And this does a particularly good job of capturing the risks of downside loss and does well in explaining the returns in markets that are characterized by extreme movements. That's where we're heading.